Welcome back to the M&A Science Podcast. This episode is part 2 of our conversation from last episode. If you missed part 1, I recommend giving that a listen first. Otherwise, let's pick it up right where we left off. Due diligence. I think it's like an important part, and just the examples you gave of investing across so many diversified industries. How do you approach due diligence? Do you have like this sort of adaptive framework for doing diligence on these different types of investments, or how do you do it?
So when we do due diligence, we have a checklist basically. We start from the top down. We look at revenues, quality of earnings, make sure that cash coming in ties to the bank statements, to the tax returns. We look at cost of goods sold. Are they buying things right? Are they spending too much? Or where we could save money. So we try to figure out that we may know ways or places that we could acquire things at a cost savings, because at the end of the day, we want to add value. So we don't want to just buy a business. We want to be able to buy it and on day one immediately add value to increase the bottom line without harming the business. We look at expenses. What are they spending money on? Are they spending money smartly or foolishly? And you'd be surprised. They spending tons of money on very, very expensive offices, or are they spending money on is everyone flying first class instead of coach? Is everybody, people tend, and expenses kind of grow. As the company grows, the fat grows along with it in terms of things that they seem like a good idea when you're a small business. Hey, let's bring in pizzas every day for lunch. And next thing you know is you have a caterer and a kitchen, and all of a sudden it's costing you millions of dollars a year to feed everybody. So you want to try to balance off where it makes sense to feed people on site. As a scenario we go through all the time, because we want people to always not leave the office. But it's a time value of money, because most people eat their lunch in 15 minutes, but if they go to lunch, it takes an hour plus. And that's lost time during the day, lost productivity.
So almost like the first view is the overall business case. So like why we're doing this deal. Does it financially make sense? Do the financial picture look good? And do the numbers sort of back into things that are validatable?
Well, first we look at do we want to be in that business? So there's lots of things we don't do, lots of things we don't want to do. We either stick to things we know or things we easily can understand. And we also want to invest in businesses that we like. Do we like what we're doing? Do we like this? Will it be fun? Will it be fun to do? Or can what we can do to the business be fun? How do we change how they do things and do it in a way that's much more effective? With all the tariffs going on right now, we're seeing all these overseas companies trying to come to the U.S. And because there's such cheap labor in a lot of China and other countries, they don't take advantage of automation. They don't take advantage of things because labor is so cheap. But in the U.S., we don't take advantage of a lot of automation either. So there's an immense opportunity to onshore all these products and goods from overseas. May go back to made in USA. You remember that from years ago.
Yeah.
And bring made in USA back, made in America. And and people say, well, people here, the cost of labor here is too expensive. But when you're doing assembly lines with robotics, you don't have that much labor. Your capex is very high, but your cost but then the robots work 24/7, 365. They don't need health insurance. They don't need unions. They don't unionize. We hope, and it's a huge opportunity.
That's a good point. So the industry that you want to be in, then you can build like the actual business case to make sure this is an area that either or you can learn quickly. And then the efficiency part was interesting, because it's like, well, how do they operate their business? Where are these opportunities for us to be more efficient about running the business? Anything like you've learned in terms of really digging in to make sure there's no gotcha surprises? Because even some of these deals that you mentioned, buying things out of bankruptcy, I feel like would be so hard to do diligence on. What have you learned to like really dig in to sort of avoid the big surprises?
With every business, there's going to be surprises. With every business, there's going to be graft and theft. Unfortunately, it's very unfortunate. You don't read about it every day, but it happens every day. And but we look for, but we're always going to find something that missed something, but we try to be thorough so we don't miss anything. As we get older, our checklist went from a very small checklist to a very large checklist. Something that was 1 page is now hundreds of pages as we go through all the different check boxes we have to do to make sure that we don't miss anything.
Hey, Mark, the big thing when I talk to people, you look at diligence, you look at the factors that drive success, it's always culture comes up big time. And I feel like there's such a wide view on the impact of culture. Some are like, you know what, once you buy the company, you're going to make the culture to what it is or what you want it to be. Where others are like, hey, I'll walk away from the deal if the culture doesn't line up. What's your sense on it?
So we have a few different premises. Family first is one thing we call it. We never want to see an employee miss their child's school play, miss a birthday, miss a baptism, maybe this extreme, miss any kid event. They have to be there for their family first. We don't want them to go home, go to their performance, and come back, do what they have to do, but we don't want people missing out on their family. That's number one. Different age groups we've noticed have different needs, and we want to try to appeal to those needs. We had a company where we decided, it was a technology company, and we were hiring people, we had an older workforce that was building. And we decided, if you were 60 or 70 years old, we still give you a job. And because we see a lot of people discriminating against age, we've thought the exact opposite. They have all these decades of knowledge on what we were building, and it was very interesting because what happens is, and we learned, is they would come in on the weekends, and we were trying to figure out why as a group. And we had probably 60, 70 people over the age of 65. No, I'm sorry. We had 100 out of 700 employees. We had 130 who were AARP members. And we saw a lot of them on the weekends. So it turned out most of them were single, mostly men, mostly single, and they had no place else to go. And so what we did is on the weekends, we made sure that they had environments that they could all sit together and have lunch. They can all sit together. And they weren't getting paid overtime. They were doing it because they wanted to be around people, and that became their social life. And so we encouraged it. And we did things for them, that made it easier for them. We got them bigger monitors to make sure they could see everything. We got them all the ergonomic tools for their desk, different chairs for some people. We made sure we had ADA bathrooms everywhere, even if beyond what the code required, to make sure that we were definitely meeting their needs. And it was then they started bringing their friends, and it was amazing. And they were very loyal. They never quit, and it just was an amazing thing. We also look at different religions. We built in our offices in California, we put a prayer room in for people who are Muslims. So for the 5 calls to prayer they could do. And we had a big prayer room, and we had a place where they could wash their hands and feet, and keep their shoes outside. And, we thought it's important to make everybody comfortable, regardless of who they are.
That's so interesting. That's like a really different lens on just going beyond just understanding the culture. It's like you're sort of catering and finding ways to create a better people experience.
Create a better people experience. We want people to feel comfortable regardless of their their religion, regardless of their race, regardless of what they do. We had a zero tolerance policy for any discrimination in the company. You don't even get a warning. It's grounds for instant termination if you are violating our rules.
I like that. So we got doing diligence, understanding the cultural piece, and that sort of lends to what are you going to do with the business afterwards, find ways that you can improve operational efficiency, but also the people experience. I got a big topic I want to run by you. This is one I really want to take apart. If anybody's listening, gotten this far, this is where you're going to earn your listening dollars over here. Capital allocation. It's something I didn't think very much about when you're running a really small business or just an early stage tech company. Now we're growing. We're about 50 people, right at 10 million ARR. And we're looking at options because there's M&A opportunities popping up, and some are profitable. And you're like, well, I can do this deal with private credit. Some are not profitable. And it's like, well, I probably need an equity partner to do this deal. And then you're looking at your own business. You're like, well, we grew 44% last year. I mean, we're strong. And I'm pretty optimistic that we're going to grow as much, if not better, this next year. So you're kind of like checking off trade-offs there. It's like, well, if I raise equity, maybe I should just wait and keep doing the organic growth and then do some of these things later on. So it's trying to get me to wrap my head and understand, capital allocation. And I feel like there's context of a private sense. And then as you mature, it changes because you obviously got more products out there, and then you got the whole public market. Teach me capital allocation.
That's a great question. Capital allocation is, it's hard because you're making decisions that affect your future. So debt versus equity, right? I'm going through this now with a friend of mine. He's got a great, amazing company. He's growing very fast, but he was thinking of selling a third of his business to raise some capital.
Yep.
And I was like, well, why? Instead of selling a third of your business, why don't you just put on some debt? And you get the same amount of money, but in the case you'll give none of your upside, none of your equity. So if he's confident, I said, if you're really confident you're going to keep growing, and he is, I'm like, so put debt on the company. That's okay. You can pay the debt, and then in 3 years when you want to sell the business, you'll own 100% of the equity, and versus only 70% of the equity if you sell off equity today. That'll be worth much more tomorrow. But you have to have confidence. But raising debt is a double-edged sword. If things go bad, all of a sudden your creditors are going to take your company. And so you have to pick your creditors. You have to build relationships with your creditors, which is very important because they have a lot of power over your future. And some days will be good days, some days will be bad days. And so you want a partner who's really going to work with you.
This episode is sponsored by DealRoom, the only M&A platform designed for buyer-led M&A. Most M&A tools were built for sellers or bankers, but if you're in corporate development, doing 2 or more deals a year, you need something built for how you work. DealRoom is purpose-built for the buy side. From pipeline through diligence, it gives you centralized control over every deal, clear visibility into tasks, timelines, and ownership, and reduces manual work with bulk updates and templated rooms, and that's buyer-led M&A. Whether you're looking to speed up diligence, keep integration on track, or just cut down on chaotic email threads, DealRoom gives you the structure to scale. Go to dealroom.net or hit the link in the episode description and check it out. Here's to the deal. The debt is cheaper capital in a sense.
Well, debt is cheaper capital if you have confidence you're going to keep growing.
Right. If you don't have confidence, okay, so this is like the venture model, right? If it's like a high risk thing, nobody really knows the outcome or probability or uncertainty, basically, then the equity is probably a better bet.
When I had my first venture business called Globix Ventures, I would always go to people in a half joking way. I would ask them if they would personally guarantee the money I put in and let me put a lien on their house and their condo and their car and their kids. And I just want to see the reaction. And they'll be like, well, I wouldn't let you put a lien on my house, but why not? You're asking me to lend you money. If you have so much confidence, why wouldn't you let me? Why wouldn't you want that? Why won't you personally guarantee it? If you're so confident that I should put up my money, why aren't you confident enough to go ahead and guarantee it? And you see the reactions. And then sometimes people say, absolutely, I'll totally do it. And we never made people do it, but we wanted to see the reaction of how they would answer the question and to give me an idea of what's going on in their head.
So you look for that confidence.
We want them to. I believe if you truly believe in what you're doing, you will be successful. But you have to be a true believer, and people sense that. When people see that you have the passion and you believe in it. And I always tell. I used to teach grad school at FIU in Florida, and I would tell my students that they should follow their dreams. Don't do something to make money. Do something because you love it, and the money will follow. And most of the time it does.
I agree. You got to have that interest that keeps you in the game long term and keeps you motivated.
Yeah. You have to really love what you do. You have to want to be at work every day. Like when I started my first company, I lived in the office. I was there 120 hours a week. Every week, I loved what I did. And I love it. And if I don't love it, then I shouldn't do it. But if I love it, it's successful.
How about when I look at doing a minority recap for our business, one of the things I'm interested in is finding the right private equity partner that could potentially bring us 2 things. One is the ability to mature M&A muscle faster. Help us the strategy, getting more sophisticated with the strategy, build pipeline, help us execute. And second is our product fits into the private equity ecosystem, right? We sell it to about 200 corp dev teams. Right now we have a handful of private equity. Can you accelerate or go to market in private equity? Because that's a whole learning curve I don't want to do all over again. That's like the incentives that are beyond capital. Do you start looking at some of those factors and saying, okay, well, maybe there are some reasons, or is it just let's keep being, I still got high confidence. I don't need them for a while. I can still, continue that 40+% growth rate. Then maybe the debt's cheaper.
I mean, with private equity, some private equity firms are amazing and they're great partners and they will really help you. Some are loan to own shops. They're going to invest in the idea of, finding a way to squeeze you out of the rest. You have to find, it depends. You have to, when you're looking at private equity firms, you should talk to the CEOs or the owners of other deals that they've done and see what their experience was with that firm.
Yep.
And that's the first thing I tell people. Just like interviewing a candidate you're going to hire, you're interviewing a private equity firm. You want to know about them, and you want to know about not only their track record, but you want to know from the people who they did business with what they thought of them. Because the firm may have made money, but they may have screwed the founder and the CEO, the founder, the person of the company, the CEO of the company.
That's a good point. That's one I'm working on now. I'm just doing a backdoor. I just go to the portcos that are sort of adjacent industries, reach out to their CEO and say, hey, talking to so-and-so, would you mind giving me a little bit about your experience with them?
Yeah, that's great.
And then that probably helps you get that. It's almost like your own personal justification of, is there going to be more accretive value beyond the capital with this partner as opposed to, otherwise I'll just go get debt.
Yeah, and there are some, KKR had a great model decades ago where they had a whole team that would help come into your business and help find ways for you to save money, like a consulting firm. And some firms still do it today. They literally will come in with a team and they'll help you figure it out. They'll help find ways for you to cut costs. They have bulk deals, whether it's with FedEx or whether it's for mobile services, what have you, that they can get you cheaper rates. But it all adds up. Pennies then turn into dollars.
Otherwise, you got the general evaluation of equity versus debt. Big factor is your confidence in your future. So that's going to be one piece of it. And then debt, there's obviously a lot of different products. It depends where your business sits. You have asset light. And then, if you, I guess your size, because I've noticed that we're bootstrapped still and you don't get as many options if you're private equity backed. So you got to sort of play with certain private credit firms. You're paying really high interest when you're in that situation. I'm curious about when as your business matures and you start thinking about these other levers that come into play. You mentioned bonds earlier, going public. You've taken a number of companies public. What's the rationale for doing that? Because now you're seeing all this private capital available. You could, like we've seen Stripe and these other companies, just stay private forever.
I think today, I believe if you take a company public, you have some sort of mental deficiency. It is such a, having done it 30 years ago, it was a lot of fun. Now it is just, you stay private. If you have any brains, you stay private. I will never do another public company again. It is just, I will keep everything private. I'll sell to private equity firms. I'll sell to somebody, but I will not go public. It's just not worth the headache. It's the same reason why, a lot of people now, last month, people won't want to run for Congress or run for office. It's just not worth the headache.
Okay, so let's say the headache in public now. I'm
throwing out there. Public scrutiny. It's everything you do.
Yeah, public scrutiny, investor relations.
Everything you do is wrong. No matter what, you can grow the company through the roof, and it's still wrong. And because you didn't do it there, because you're growing 100% a year, and if you grow 99% one year, oh my God, you're a failure. And it's just with social media, you got all these people, short sellers are out there all over social media, just bashing on you. And I'm like, it's just not worth it. It's not worth the headache. X is not your friend. And
so you got like anybody can be an activist now because of that.
They can be. It is mind-boggling how many people out there, and they're probably 14-year-old kids sitting there doing this, or people in China doing this. It's just mass rooms. It's just people who are just bashing you. And it's like I don't need this. And I stopped looking at social media. I was like, it's just not as much fun as it used to be.
Okay, I'll rule out going public. I'll maybe it'll be like I could exit to a public company and call it a day.
There you go.
I can sit there, take a stock, hold a roll for a title for a year or two, and then call it quits.
Exactly, 6 months, be done.
What are other levers? We got. There's obviously private equity runs the gamut. You got VC, you got different private equity from majority to minority owners. You got just individuals.
You have sovereign wealth funds. I mean,
then large institutional side.
yeah, they are become massive, and your family offices now have become massive. I mean, so much wealth has been created in the past 20 years. I mean, it's phenomenal. I mean, think about it. To get them the Forbes 400, 25 years ago, you needed $750 million of net worth. Today, it's, I don't even know how many billions it is to make the Forbes 400. I mean, the numbers of the wealth that's been created in this country is just, and all over the world, is just phenomenal. And these family home offices, they buy businesses and they invest and they put their money to work. And so it's a whole that they've become, family offices have become a powerhouse, a juggernaut in the investing world that just didn't exist 25 years ago.
Is there, we have this capital structure. There's all of this different equity options, and then debt as well. I think private credit's opened up a bunch of different options and products as well. Is the math like something? I want to understand. Again, go back to capital allocation broadly. How do you do the math in your head? Because I know you've got a strong investor lens. Is it, hey, I'm looking at 5 years out. I want to be at this target IRR, and you're working backwards? Because for me, I'm still that bootstrap mentality. Like, I'm just going to work my ass off day in, day out. And at the end of the year, I'll sit with the tax accountant and look at the numbers, and he'll tell me how I did. But, I'm kind of curious from your sense if you've got a different view of how you think about capital allocation from what you're targeting returns and working backwards, or is there just a different way that you look at it?
I mean, we look at capital allocation, where do we get the biggest bang for the buck? Risk adjusted. So what's the risk?
Okay.
And so if it's a sure thing, and sure thing can be defined a million different ways, we do it. I mean, like right now, I've been buying up for the past year lots of bonds in banks, and I'm getting paid 7-8% coupons right now. So I thought it was a good portfolio move, and it's turned out to be a great portfolio move in this market right now. And equities have gotten pretty, right now, holding pretty flat on. Market's down a lot, and I'm pretty flat. Yep. So we made some good equity choices. But when you're investing in companies, private companies, it's all about risk reward. What's the odds they're going to succeed? What's the odds they're going to be a winner? And you're betting on not just jockeying the horse. You're betting on the industry. Is industry going to be a gold mine? Like, we've spent a lot of time lately looking at small modular reactors. We spent a lot of brain cycles trying to figure out now how we can mass produce them. How can we do it cheaper? How we ways we can do it. At the end of the day, we can't figure out a way to get it below 4 cents a kilowatt. It just doesn't. Math doesn't work. And no matter how hard we tried on paper, no matter how much we wanted to be able to do it, we couldn't figure out a scenario that it's cheaper than cheaper than natural gas.
So then you profile as a high risk. Like, there's so much uncertainty.
We profile it as a super high risk.
Then your expectation is like a much higher return.
We had this vision that we could make a lot of money doing it because there are all these data centers being built and they need power, and there's not enough power in the U.S. But at the end of the day, it's not going to come from small modular reactors. It doesn't work. The math doesn't work, and we were all very disappointed because we spent months on this project, and we just couldn't figure it out.
How far are you looking out? Are you sort of looking at your investment, thesis in a certain time frame, or does it just completely vary?
It varies from day to day. I mean, everything. Like right now, real estate has me all excited. I'm watching the real estate markets around the country start to soften, or like San Francisco just collapse over all in. People are buying things for 20 cents on the dollar in office buildings in San Francisco.
I've seen it in Chicago too.
I look out of my window of my hotel here. I see vacant floors all over the place in all these office buildings. I don't know what the vacancy rate in New York City is, but it's dropping like a rock. It's going up. I mean, there's so much empty space everywhere. Retail around New York City, there's tons of empty stores. And so, you're going to see, I'm seeing in Miami where I live, prices are coming down. People are getting, and what's going to happen is you're seeing the inventory of things for sale in Miami skyrocket. You're seeing the number of sales drop dramatically. Interest rates have gone up dramatically. No one's buying, and that's going to start putting huge pressure on people who have to sell to really start lowering their prices. And we're seeing some great opportunities all around Miami now to buy real estate, and because people realize that a year from now it's going to be a lot cheaper.
Yeah, that varies on that strategy of what your whole period is going to look like and what the outlook is. And
but that's we try to we some asset classes like real estate. I view them as long term holds. You buy a project, but you always want to buy the worst building on the block because you can make it the best. You never want to buy the best building on the block because what are you going to do with it?
Yeah, the opportunity to add value.
Yep.
what do you do when things go sideways? You've seen this before. You've seen it in the .com bubble boom. You've just had investments. You gave the watch example. Teach me how to handle it, because I want to get a sense that I can be as optimistic about our business, but I feel like when things go sideways, you tend to be blindsided by it. I don't know. Can you coach me on how to mentally be ready to do that?
First, always make sure you're working on the first floor of the building. Then you can't jump. Second, keep Xanax far away from you, because you're just going to want to keep taking some.
Okay.
Third, it's make sure you have a good closet to hide in, a good desk to crawl under, and no, seriously, I'm just joking. Obviously, well, maybe not the first floor thing, but you want to make sure that it's hard. You have to own what's wrong, and you have to really first you have to realize the buck stops with you. If you're the CEO, the buck stops with you. You have nobody to blame but yourself, and you have to. Once you own that, then you figure out then you work the problem, and you have to work it, and it's easier said than done. And but the whole idea is you get the smartest people you can into a room. How did the problem happen? How do we fix the problem, and how do we prevent it from happening again? And we've seen lots of mistakes being made by people, but regardless of who made the mistake, at the end of the day, the buck stops with me, and I have to own it, and I have to work it, and I have to fix it, and I just have to push through. And as my old partner used to say, you brute force it. You just figure it out, and you go home until you figure it out. And because all problems can be solved, and it just requires sometimes some creative thinking, and sometimes it just requires some fresh air. And you go for a walk, and you tune out the world, and you think, and you come up with a solution. But only you have to own it, and because people always want to blame everybody else. No, and I always tell people who work for me, if you make a mistake, own it. I think I said earlier, it's okay to make mistakes. And the call we had, I don't care if an employee makes a mistake. I care that they own it. They come to me right away. They say, "Yep, I messed something up." I said, "That's fine. How are you going to fix it?" And I want to teach them how to solve the problems. But because I know at the end of the day, the buck does stop with me, though.
So for you, it's a big part about ownership. There's no philosophy on how paranoid you should be about what's around the corner. It's more of just,
No, you should be paranoid because everyone's out to get you. Just read X.
Right. That's true.
Yeah, but that's it. No, it's just, you have to, that's the downside of public companies, because everyone's out to get you.
Everyone is.
And that said, despite how much money you've made people over the years, they only care about what you're making them today. And so it's everyone's about what you've done for me today. Forget about yesterday. That's why staying private is a great idea. But you want to, you have to you have to figure it out, and you own it. And that's the easy part is to get up there, get on stage, say, I made a mistake. This is the mistake I made, and this is how we're solving the problem, and we're going to solve the problem together. And that is most people don't. I learned at big companies, nobody wants to take ownership, because if you don't take ownership, then no one can. It can be nobody's fault, because they just point fingers at each other, and because it was a group decision.
Yeah, that's why it takes so long to get anything done. And
exactly.
how to fix the problem as well. What you were in hospitality before?
Yeah, so it was very funny. We started investing in restaurants and nightclubs. We invested in New York City in restaurants like Lavo, Artichoke Whistle Pizza, Catch. We had a club called Avenue. We did invested in Bongos in Miami, Philippe Chow. We invested in Lolita's Tequila Bar. We invested in, a wide range of venues. And it was all about, at the end of the day, we had Piano Bash, Munch Bar, and it was all about investing in things that it was all about solving a problem. And the problem is I hated waiting for a table. And that's how it started. Is if you want to eat and it's a busy Saturday night, you can't get a table a lot of places. So I decided I wanted to invest in an Italian restaurant,
big venue,
an Asian restaurant, a fish place, all the major food groups I would eat. And the only thing I never did was a steakhouse. That was the only thing I never did. And then I love music, so I love nightclubs. So we started investing in nightclubs, and it was a passion play. But I had amazing partners across the board, and it was very profitable.
Wow.
And so I made money, and I solved a problem. I could always get a reservation. So it worked.
I'm going to start using that. I'm going to drop your name and see if I can start getting in some of those places.
It doesn't work anymore. We sold them all, unfortunately.
Sold them all.
Sold them all, unfortunately.
That's all right. It sounds like a familiar name. Marc Bell.
Exactly.
I'll still use it. I know Marc Bell.
People do it still to this day. People call me up like, do you know? I'm like, seriously?
Oh, it's so funny. Looking back, which deal taught you the hardest lesson? How did that experience reshape how you evaluate or structure deals today?
I got a lot of those. Which deal taught me what's the deal's the hardest lesson?
Yeah, like the big. Mark, what was like looking back at your career? What are some like the big top lessons learned from experience on deals? Yeah, I'm trying to shorten my learning curve here.
It's picking your partners. It's probably the thing that the biggest lesson I learned. I've had some amazing, spectacular partners. I've had some amazing, spectacular lenders, amazing, spectacular equity investors. And I've had the exact opposite. I've had the world's worst lenders, the world's worst partners. I've had partners who've stolen. I've had lenders who broke every rule in the book. I've had, some people are amazing, and some people can be real pricks. And, they don't, at the end of the day, that's why I said, make sure you talk to people to see who you're getting in bed with. That's the one mistake I didn't do, is talk to people to who I was getting in bed with.
I think that's really true. I feel like I learned that a lot, especially from doing this podcast. When you interview somebody, you get a really good sense of the character, who they are, but you get a sense of that network effect too. And, you start seeing that it's like a bad character there. Usually all associations tend to be in the similar vein. So I think that makes sense for you to go back, do the references, like we used the example with the PE firm, talk to those other owners, get a sense of
it's by far my biggest mistake.
Okay. Number one. So that's number one thing I'm going to take away from this interview is them going deep into those reference
You need
checks.
to know who your partners are going to be. It's just like relationships. You need to know, you want to know, this is why people don't get married right away. You want to make sure that person is the right person for you.
Yeah.
Because it's a relationship, and you want it to work.
That's true. That's great advice. What's the craziest thing you've seen in M&A?
Craziest thing I've seen in M&A?
Yeah.
I've seen a lot of crazy things in M&A. I'll give you a crazy story, which isn't M&A, but it goes to the crazy things of bad investing. A friend of mine went ahead, was buying a house in New York. They inspected the house the day before closing. They closed. They went after the closing back to the house. House was gone. House burnt down the night before. So the guy who owned the house got his money from selling the house, and he got the insurance money for the house being burnt down. And my friend who buying the house was left with nothing.
What?
Craziness. And they never could prove arson, never could prove anything. And the guy got paid double, and my friend was left with a piece of dirt with rubble. Craziest thing. You asked for crazy. I can't make this shit up.
Because it burnt down before.
You're supposed to inspect a house an hour before closing, not the day before closing. That's the lesson learned.
Yeah, you do it right then.
Yeah.
We waive the inspection's done, the contingency's
I mean,
done.
now every time we buy something, we have somebody on site during the closing. We do, because that's why we saw. I remember this. I remember what happened, and what my friend went through. So we literally have a person who sits there during the closing to make sure nothing happens to the building.
Because the house burnt down. They closed the next day because they didn't look at the house.
So the guy got paid his insurance money on the house burning down,
and he got paid. Technically, had ownership,
and he got wired all the money for the house.
And they got that house the next day. Wow. Then you're right.
Yep. Crazy.
You went pretty extreme on that crazy. I'm like,
it just came to me.
Can we go out for drinks? I want to get the other 99 stories below that. Mark, this has been a great conversation. I appreciate you taking the time, helping me become a better M&A scientist here.
Listen, thank you so much for having me today. It's really been a blast. I really appreciate it.
Fellow M&A scientists, you've gotten this far. You're a true M&A scientist. Love to hear from you. I know we switched things up with this interview. Got Mark, a savvy investor, to teach me a few things, learn from his experience. reach out to me on LinkedIn. I'd love to hear feedback on this interview. If you have other topic ideas, things I should be covering, if you just wanted to rip on me and criticize me and how I can do better at this, I'm open. I'll take it. That's how I get better. Till next time, here's to the deal.